Good morning. Welcome to Ainsley News. It's Friday, 15th of January, end of week news. Hopefully many of you survived your first week back at work okay. For those starting next week, good luck to you. Today we're talking Biden's $2 trillion stimulus and the most important event of your investing lives. Markets are aflutter with the reports yesterday of CNN on a $2 trillion stimulus package to be announced tonight, US time or this morning hours, by Biden, and now the New York Times confirming it will be $1.9 trillion and include a $1,400 helicopter money check for individuals to top up December's $600 check to the desired $2,000 total. So let's unpack this a little bit. Firstly, may we remind ourselves of the need for such an incredible stimulus package when a share market at near all-time highs is signaling that everything's awesome. Last night also revealed more troubling data on the US unemployment situation after Friday's terrible NFP employment figures, or non-farm payroll employment figures, 140,000 lost jobs. 140,000 lost jobs, for December. And this from the Financial Times. The pace of new US jobless claims accelerated last week to the highest level since August as the labour market continued to struggle amid a relentless surge in coronavirus cases and deaths. There were seasonally adjusted 965,000 initial applications for employment or unemployment aid last week, higher than the 784,000 claims during the prior week, according to the Department of Labour on Thursday. Economists had forecast that 795,000 claims were filed last week alone. For context, the stickier continuing claims is still 3 times higher than that before the pandemic, at 5.3 million Americans on unemployment benefits, up 200,000 from a week earlier, but still nearly half the peak of 10.6 million people in September. More focus seems to be on the halving from the peak than on the tripling of the norm. Exacerbating this, the rates of vaccinations in the US has fallen well short of expectations, and now the UK strain is there at a time when infections and deaths were already at critical levels. The chief economist for the World Bank, Carmen Reinhart, yesterday reinforced that confusing focus by stating, "Don't confuse the rebound with a recovery," and expanding, "A rebound this year still leaves per capita income below where it was before the COVID crisis. Calling it a recovery is misleading." As we've spoken often of Raoul Pal's playbook of this crisis, starting with the liquidation phase we saw last February and March, the hope phase arguably still playing out, and then the inevitable insolvency phase. The latter is a balance sheet issue that no amount of stimulus can prevent. Many businesses are structurally broke. Reinhart clearly agrees, stating she is very concerned the longer this goes on, the more strain on balance sheets of individuals, households, firms and countries. It's a cumulative toll that I think will create classic balance sheet problems. As we've continually warned too, there is a misguided feeling that of all being okay as the likes of JobKeeper, JobSeeker, and mortgage holidays are keeping businesses and individuals afloat, meaning, as she says, there's been a problem that has been delayed but not avoided. She calls this a quiet financial crisis, as so many are ignorant of what's really happening. And so throwing more stimulus at this situation is simply kicking the can down the road. But it's not a free ride, bringing us to the second point, and that is debt. Another $2 trillion in deficit spending adds to the already stratospheric US debt. As a reminder, the US is already near an all-time high against GDP, surpassed only by that accumulated to fund World War II. Their own congressional budget office projects this to continue unabated, as per this chart we're going to show here. This is the federal debt held by the public from 1900 to anticipated 2050. This stimulus announcement, though largely expected, has seen bond yields rise yet again overnight. Rising rates while holding that much debt could be catastrophic. The everything bubble was already there before the pandemic. Yes, the pandemic pricked the bubble, but central banks and governments are desperately pumping air into it again. Investment legend and founder of GMO, Jeremy Grantham, CBE, is 82 years old and has seen a bubble or two, and published a paper earlier this year titled Waiting for the Last Dance, The Hazards of Asset Allocation in a Late-Stage Major Bubble. His opening paragraphs should serve as warning for all. The long bull market since 2009 has finally matured into a fully fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and hysterically speculative investor behaviour. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea bubble in 1929 and 2000. These great bubbles are where fortunes are made and lost, and where investors truly prove their mettle. For positioning a portfolio to avoid the worst pain of a major bubble breaking is likely the most difficult part. Every career incentive in the industry and every fault of individual human psychology will work towards sucking investors in. But this bubble will burst in due time, no matter how hard the Fed tries to support it, with consequent damaging effects on the economy and on portfolios. Make no mistake, for the majority of investors today, this could well be the most important event of your investing lives. Speaking as an old student and historian of markets, it is intellectually exciting and terrifying at the same time. It is a privilege to ride through a market like this one more time. It's not this morning's $2 trillion announcement at play here. It's the fact that we now have Yellen in charge of fiscal and Power in charge of monetary stimulus, and a blue sweep that won't stop this. Heed his words and protect yourself. Big news today. Hopefully you enjoyed it. If you're interested in any physical gold and silver bullion, jump over to ainsleyBullion.com.au. Still riding that crypto wave, jump over to ainsleywealth.com.au. You can order by just selecting your product and then placing it, and we'll send you through an invoice. It's that simple to buy crypto with Ainsley Wealth. And if you're interested in our cryptocurrency built and backed by real gold and silver and stored at Reserve Vault, check out goldsilverstandard.com. And that's available to be purchased on a number of exchanges, notably CoinSpot. And you can also buy it through Ainsley Wealth too. Enjoy your weekend, everyone, and we'll catch you on Monday.